Hey, I think we're live. Very good. So I got my mouse in my hand, so that's what you'll see me using. Um, I want to thank each and every single one of you for being here today. I'm looking at something. Okay. I want to thank each and every single one of you for taking the next step on your financial journey to actually learn something and maybe implement that over the next few months to hopefully, within at least a year for some of you. Um, this was a kind of a webinar that was brought on to me out of request. So I'm going to be recording this and uploading this and streaming this. So um, without further ado, over the next few minutes, I'm not going to sell you anything. I just want to walk you through something that's happening in the market right now. An opportunity that's quietly opening up while most people sit on the sidelines, waiting for rates to drop. Here's the idea I want you to leave with. You don't need rates to fall to do well. You need to understand where the real opportunity is and be positioned before everyone else arrives. So let's look at what's actually going on. Mouse isn't working. There it is. So, one quick note before we start. Everything I'm sharing today is for educational purpose only. This is not an offer. This is not a solicitation. This is not financial advice. I'm not a lawyer. Okay. So let's start with the problem because it's the reason this opportunity exists at all. The cost of sitting still is that cash depreciates faster than it earns interest. And that drag quietly offsets your gains the day you finally decide to deploy. And this isn't theory. Since 2020, the United States dollar has lost roughly 1/5 of its purchasing power to inflation. Wow! Now let's go back to the 1970s. Cash lost nearly half of its value in the 70s while savers sat and waited for things to calm down. The pattern keeps repeating. Waiting for rates to drop is really just a forecast dressed up as a strategy. Relationships never changes, okay? Waiting protects nothing, and owning real assets does compound. So here's what the market money did, okay? Or I'm sorry, the smart money did. Instead of trying to time the bottom, the most sophisticated capital in the country started deploying into real assets while rates were still high. In 2024, Blackstone bought AIR Communities for a whopping $10 billion. KKR picked up roughly $2 billion of apartments. Institutional money kept pouring into the build to rent. And all of that happened during high rate stretch, not after some all clear signal, okay? But notice what they bought: apartments and multifamily. That lane is now crowded and priced for institutions. The easy edge there is gone. So the real question becomes, where is the real asset opportunity that the big players have not already saturated? I'm going to lay out what I've trademarked as the raise opportunity. The way I make sense of all of this is with 5 forces. And I keep them organized under one word: RAISE. I want to be clear about this. It isn't a sales framework, it's just how I read the market. 5 separate forces that happen to be lining up at the same time. Any one of them on its own is interesting. The rare part is to have all 5 that are pointing in the same direction at once. That's what turns a trend into a genuine window. So let me walk you through each one. The first force that is that real assets are winning. R, real assets. When markets get volatile, capital rotates out of paper and into things you can touch. Land and buildings hold their value precisely when financial assets get shaky. The first edge in any cycle is simply being positioned where the capital is already heading. And right now, that direction is hard assets. A, the second force is acquisition below appraisal. The advantage in this space shows up at entry, not at exit. Projects in this category can often be acquired below appraised value. So the gap between what it costs and what it appraises for becomes a built-in margin, equity that exists on day one. That's the difference between hoping the market appreciates, which is speculation, and starting with a spread before the market does anything at all. In this kind of asset, you can make your money going in, not just coming out. And the third force is I. It's for institutional vacuum. And this one is really the heart of it all. Here's why a lot of the obvious real estate plays don't actually work right now. Take multifamily. Institutions and large players already own and price that market. It is saturated. The vacuum is gone. The real opportunity sits in a fragmented categories that they ignore. The ones run by local builders and one-off operators with no institutional standard and no dominant player. A leaderless market in a growing category isn't a risk. It's an open seat at the top. And the opening is there for someone to bring a repeatable institutional standard to a space that has never had one. S, the fourth force. This is surging rate-proof demand. Okay, what does that mean? The demand driving this is structural. People want affordable, flexible, space-forward homes, and that desire doesn't switch off just because rates went up. The buyer pool is broad, right? So move-up families, empty nesters who want space without all that maintenance, and short-term rental operators chasing the cost basis advantage. Demand that keeps growing whether rates rise or fall or stay flat is what makes it resilient by design. E, our fifth force. This is emerging category upside, right? So the biggest gains almost always come from emerging categories, not crowded ones. Think Amazon, think Tesla, think SpaceX. Early positioning in a rising category captures the most upside. And value gets added by developing and improving the asset, instead of things waiting on the market to do the work. Getting in early is the difference between riding the curve and chasing it. FOMO. So the question is, what category sits right in the middle of all five of these? When you put all five forces on the table and ask where they overlap at the same time, only a handful of categories check every box. Like I said, any one of those alone is interesting, but all five, one checks all five. Barn dominium developments. It's a real asset. It can be acquired below appraisal. It sits in a wide open institutional vacuum. The demand is surging and rate proof. And it's an emerging category with room to run. And the next leg of growth is closer in math, okay? because the vertical build cost is lower. The model can absorb higher land bases closer to metros, which opens up an even bigger market. So the opportunity is clear. The only real question left is how someone actually captures it without becoming a builder themselves. And that's where I'll briefly introduce what we do. Fortified Capital raises capital from accredited investors and deploys it into barndominium development projects. The exact spots where all 5 of these forces line up. It's a way to get exposure to the opportunity without having to find the land, manage a build, or learn a brand new business. We bring the strategy and the execution. The investor brings the capital. It's one vehicle built for this specific moment. So you can participate in the opening instead of watching it from the sidelines, because once it hits headlines, it's already too late. Now, this isn't for everyone, and it is only available to accredited investors. Again, this is not a pitch. This is my framework that I want to explain to you. But there's only one category that meets all 5 of these trends. That tends to fit to people that have capital sitting idle, quietly eroding to inflation, and are tired of watching it lose ground. People who trust real, tangible assets over paper money. People who want growth, not just a monthly check, and people would rather move early in an opening than read about it after it is closed. And honestly, people who make decisions in real conversations, not by committee, okay? If that sounds like you, the next step is simple. And that next step is just a conversation, not a commitment, just about 20 minutes to see if the way I've described this lines up with how you think about your own capital. The scarcity here is real. It's not manufactured. Early positioning is the entire point, and these windows narrow as more capital notices them. So if this resonates, reach out, book a call, let's talk. No pressure, just 2 people looking honestly at the same opportunity. Thank you. See if I got any questions.